It's not just about your credit and down payment. If you want the lowest rate, you got to know these three things. And to help you further, I'll also be providing for you a link through this video to give you an aid in holding your loan officer accountable for the best rate that day. Before we dive in, I just want to ask you guys, please comment any questions you have as you watch this video. We'd really love to make sure that anything we're bringing up that's contrary to conventional wisdom, you're able to just kind of share your thoughts on so that we can go have a conversation and just help more people. In addition, we'd also ask for you to like and share so that more people in the community can get that better advice they deserve. So first, when we're looking at the rate and we're trying to get the lowest, let's identify the elephant in the room. Why are we trying to do this? Because we want the most savings, right? And when you're being told that it's really not that much of a difference, well, let's let the numbers speak for themselves. When you look at the difference of what half a percentage point in rate could do, right? So you look at a $500,000 purchase price, you look at one option being a 3.25 and the other option being a 3.75, that difference of rate in about 15 years will be over $27,000 of interest alone. So when we're looking at, hey, I want the lowest rate, this is coming from that heart of, I want to be able to take care of my family in the best way possible. With those good motivations and intentions, we want to couple that with the right knowledge. Conventional wisdom sometimes doesn't help us have the best thought process in regards to accomplishing the savings that we are intentionally wanting to get. Now, for example, one of these scenarios that conventional wisdom is not always helpful in is when conventional wisdom says, do not buy a house until you have 20%. We'll make other videos on this too, but do not buy a house unless you have 20%. One of the things that people don't realize often is a borrower with 20% down compared to a borrower with 19% down. The borrower with 19% down is usually going to get a better interest rate. What? Why? Well, think of it logically, right? What does the 19% borrower have that the 20% doesn't? It's called mortgage insurance. So for example, in your life, if you were going to let somebody borrow your car and drive it, would you rather trust somebody with insurance or without insurance? In the same light, investors are analyzing details in the same way. They see lower risk in a borrower that has the mortgage insurance because now there's a third-party company involved that they can be reconciled with if a default does take place. So therefore, lower risk, better price. In addition, a lot of times we get distracted by trying to identify the lowest interest rate with the APR designation, right? And so many times we're so focused on APR because that's all we're taught in school to look at. We forget APR might sometimes not be the best plumb line for us in regards to comparing option A and option B. APR is the total cost of the transaction over 30 years. Sometimes you see some fees change. Sometimes you see that APR variable change once mortgage insurance is put in or prepaid interest or whatever. And so it's not usually the best tool to be able to use. One of the tools I would give you is identifying what your EPR is. EPR, what does that stand for? Effective percentage rate. Your EPR is going to be how much are you actually paying on a regular basis for the money you're borrowing. For example, if I would ask you, hey, what's a better scenario? Someone who has a 2.875 rate or someone who has a 3.125 rate? You would probably respond saying the 2.875 rate, duh. Well, again, when you look at EPR, you're going to be able to identify that the person who has the most savings is actually the person with the 3.125. What do I mean? Well, even here in this illustration, as you compare the 3.125 rate and the 2.875 rate, same purchase price, same loan amount, the monthly payment difference is $181. Why? Because here we're looking at a FHA option, which generally tend to have lower rates, but the mortgage insurance is higher for well-qualified borrowers. Here, we're looking at a conventional option with really well-qualified buyers where their mortgage insurance is much less. So the mortgage insurance on the conventional with the well-qualified is $91 a month in this scenario. And the mortgage insurance for the FHA borrower, no matter how well-qualified they are, is $336. Again, this is where interest rate, APR is helpful But sometimes if you don't pay attention to your EPR, you're missing the most helpful. So understanding EPR, now we have to also understand what the next variable is, right? If you're wanting to get the best rate, yes, make sure you're using all tools, especially the most helpful like EPR. But in addition, understand that one of the major components of you getting the best rate is not really who you're working with. It's when are you locking the rate with the person you're working with? What do I mean by that? Well, keep in mind, mortgage rates and the way they're created can be very similar to the example of gas stations. When you think of gas stations catty corner to one another, isn't it magical to see that on the same day, both their prices go up, and on those same days as well, both their prices go down? Do you believe the owners are just having coffee or dessert the night before and identifying how high they want to go or how low? No. Their margins are based on the cost of oil, and the way oil trades in the marketplace now affects what the gas price is going to be. In that same principle, mortgage rates are very similar. Mortgage rates with margins on the bank are based on mortgage-backed security yields. So, when the mortgage-backed security yields go up, let me clarify, mortgage-backed security in relation to rates, it's an inverse coupon. And so when mortgage-backed security yields go up, you're actually going to be seeing rates go down, and vice versa. When they go down, rates go up. And so, for example, as we examine this on the charts, look at the timing differences. This season, we're coming out of this COVID era, and so many people are like, man, where are those super low rates we used to hear about? Well, those existed here in August, here in September, here in January, and then here as we get closer to February, you know what's going to be interesting? You're going to see from February 11th, we started going downwards. February 11th, we started going downwards, then we came back up, and then we still went downwards. And as this went down, what happened to rates? They went up all the way there to May 19th. We saw a movement in the market that created an exodus from the 2s into the 3s. And then we went back into the lower rates, back up, back, and it's just been this roller coaster. And this hasn't been because all the conglomerates are getting together and trying to see where they can get Americans on interest rates. It's just because of the differences of how the mortgage-backed securities are operating. So what do I want to point out here? If you look at some of these days, like let's say you got into escrow here on May 20th and you're looking at locking the rate and you're not paying attention to some of the news, or if there's some triggers or clarifiers that are showing you that you're in a trading range. And in that trading range, you're in this cycle where floating might get you up on the chart, meaning get you a lower rate. So you can speak to, let's say, 4 banks here on May 20th and see somebody offer you a 3.25, 3.375, and 3.125, and you go with the 3.125 guy, even though you don't really like him and you don't know if you can trust him all the way. But hey, he got you the lowest rate, so you're being responsible. And what you can miss out on is if you had somebody that can help you identify when it's wise to lock or not lock. The truth is, here on May 25th, you might have gotten a 3% with that guy who gave you better advice. Mortgage rates change daily and on a regular basis. Timing is going to be able to help you capture those best savings. So please, 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 when you get into escrow, have an examination with your loan officer of where the market is. Ask them where the trends are leading. Where are you in the trading range? Are you on the bottom or are you on the top? Should you float or should you lock? So you can truly see the best savings possible for you and your family. So as we look at EPR being a great helpful tool, and we look at timing, so when we look at these 3 components of helping you identify the best rate, where you're not just getting distracted with the interest rate or the APR, but you're also taking consideration in EPR. And then when we look at the timing of being able to capture rates in regards to how they're performing in the marketplace and being able to get that lower rate at that right time, the third component we want to analyze is going to be in regards to mortgage management. Once you get into this 30-year loan and you're done with the escrow process, it doesn't mean you're done with the mortgage, right? You have 30 years with this loan. How do you ensure you're getting the best rate is not just a question to answer in one moment in time, but because 30 years is going to be such a big aspect of someone's life, it's a question that needs to be answered continually. How do I get the best rate over and over and over? Like we just saw, the marketplace changes. Not only is it changing until you get into escrow, but after you close on your loan, it still changes. And if you are looking at your EPR and you have mortgage insurance there, even with the market changing, you need to make sure that your team is keeping you in the loop so you know when it changes enough for you to capture more savings. I am very proud to know that we're able to help a lot of families throughout the country. And I can tell you from my experience, I have still not met one person who knows one person who's had their loan for 30 years. Yes, house for 30 years, absolutely, but not loan. Some studies have shown that the average American will refinance it between 8 to 12 years. And when you see why, it makes a lot of sense. So let me bring you back to the charts here, and we'll look at this big picture, right? We want to identify there are moments in time where the market creates savings for a consumer, and that consumer will only capture those savings if they're in the know. Sometimes it ends up on the news, other times it doesn't. Sometimes making some steps helps you capture those savings, or sometimes you're caught off guard and your credit card balances are higher, therefore your credit score is lower and you don't capture the rate because you weren't even in the know that it was there. And by the time it got to the news, you called the loan officer and it was gone. I've had families come into our office where they've shared, hey, I want to know your rate because I'm going to compare you to 3 or 4 other people. Great, compare all you want, right? We're very proud of where we're at price-wise. We love being able to know that we're offering a really great competitive price for an amazing service. But as I got to know her story a little bit more, and as we got to dig in, we saw that she had owned a home for over 5 years. And when she first bought, she acted out in the responsibility she was taught. She asked a bunch of lenders what their rates were. She got the quotes and she went with the lowest. Yet, that's where it stopped for her until the next home purchase. And in between those 2 times, there was multiple opportunities for her to have saved thousands of dollars through a refinance, even in light of her selling soon. Yet, she was never in the know. Events like Brexit, presidential elections, events like COVID completely changes the marketplace, right? Here, you can see when COVID really started having its impact on March 9th, March 10th, all of a sudden the markets went completely crazy with such instability that rates were all over the place. And again, then we started stabilizing. If you would have gotten your loan here in 2019, and you didn't have someone to help you manage to be in a better spot as values increase and needed a higher FICO score or needed to just be aware of what you needed to do from a debt to income ratio perspective for budgetary reasons, you could have missed out on those savings even though they were there for the picking. Having a loan officer team manage your mortgage and provide for you resources via updates, alerts, data, and intentional and proactive assistance to help you always be in the best mortgage possible will save you more than anything else, given the opportunities of rates fluctuating and opening those doors of savings for you. Your rate is your rate, but you never want to leave the opportunity on the door where a lower option with better terms and conditions can now provide you and your family the better savings you were hoping for. Identifying the fact that different lenders are going to offer you different things. Some just give you debt. Others give you more than a sales pitch and true proactive commitment to help you in ways that you didn't even know were available to get help in. Some of those helpful tips would be in the form of something called a credit simulator and rapid rescores, which means effectively, if they see and identify that you're right there on the cusp of bringing your score up, and bringing your score up would equate to a better EPR because you'd have better mortgage insurance, you have better interest rate, they can run simulators. It does come at a cost. They can complete rapid rescores where your FICO score can come up within a 2 to 4 week period before you even close on the home. Ask your loan officer what tools they have available to you so you can identify what caliber of professional am I working with. As promised, I want to give you a tool to help you keep your loan officer accountable. If you want to know what average interest rates are, not Googling on bank rate and then identifying that there are some hidden pieces here, or the person you're speaking with is wearing flip-flops and board shorts and just got out of their college class, doesn't know a lot about a personal finance, and they're calling from some call center in the middle of the country, right? If you don't want to go through those channels and not really feel secure or understand where the average interest rates are, here is a helpful website for you. So let's have you go straight into we'll go into what I like most, Google, and what you're going to search for is something called Optimal Blue. Optimal Blue is a website, third party, that many mortgage companies in the United States use. And so when you go to this website, you're going to be able to identify something really helpful for you. What you're going to be able to identify is the average interest rate all these companies are pricing out on. So as you scroll down, you'll be able to find this section here, daily mortgage rates. Average 30-year fixed rate mortgage to date, June 18th, or last updated June 18th, was for a 30-year conforming loan, 3.22. If you want to identify the trends, this is now going to let you take it a step further. Not only can you see what the averages are on that date, but you can go into the dates before, and you can even play with the different products so that you can see, hey, if I'm going conforming, meaning that you're in a conventional type of loan amounts less than 548 in some counties and others 822, and my FICO score is between 700 and 719, and my loan to value, meaning how much down payment am I putting, right, is, let's take that off, it's less than 80%, so that means you're putting less than 20% down. What would my interest rate be? Oh, 3.222. Great. Now I can use this to see if my loan officer is giving me something fair or not. So again, go to Google, look for Optimal Blue. Once you go to Optimal Blue, scroll down to see the daily mortgage rates and then hit the view trends, and you can identify this for yourself as you shop and try to make sure that you're getting something fair, competitive, and most of all, something to help you ensure that the loan officer you're working with is giving you the data that's appropriate to the right context. Again, the 3 components to make sure you know for the best rate is to not just look at interest or APR, but identify EPR, right? Because the goal of a low rate is savings, and EPR is going to be a tool to help you get those. Second, timing of the marketplace, viewing trends, identifying is it best to lock or flow, and having that conversation with a mortgage professional who actually knows what they're talking about is imperative. And lastly, being provided resources that are going to proactively and intentionally help you capture those savings when they come. Those 3 factors are going to help you capture what you want with the lowest rate, which is savings. With all that said, I hope that's helpful. Let me know your thoughts, and we'll chat more soon.